One of the big takeaways from last week is that we had bonds and stocks interacting in a more traditional way. When equities were down on Wednesday, bonds were firm. And then on Friday, when stocks ripped on good data, bond yields ripped too. Jay Pelosky joins us from TPW Advisory to assess the macro situation connected to investing. Of course, he's a founder and global strategist at TPW. Jay, great to have you back.
Oliver, nice to see you. Happy Monday.
Appreciate that. We made it through the first month of the year, and it was a packed last week. One of my big takeaways was that we kind of normalized the stock-bond relationship. Is there some hope that equities can keep rallying even if yields do too?
Yeah, I think that's right. And I think it's a recognition by the market that growth is good, right? And we're not so much concerned about lower rates supporting a weak economy. We're focusing more, particularly at TPW, more on the fact that we believe we are in a new macro regime, that we are in the early cycle, and that the outlook is robust, and not just for the next couple months or even the next year. We're really trying to broaden the lens a little bit, or widen the lens, Oliver, and look 2024 to 2026. And we're constructive over that 3-year period, which then allows you to think maybe a little bit differently about, the next week or the next month, right? Where it's much harder to figure out exactly which way we're going to go. But I think the trend and our big takeaway is that the trend is towards global growth and early cycle, not late cycle going into recession.
That's a big statement that seems to be pretty well supported by data. I called it the trampoline landing last year, where we bounced back, but maybe we should just eliminate landings overall. Do you think it's time to move on from that discussion about an imminent risk to the economy?
Yeah, I absolutely do. And we've done a lot of work on this, and we've been talking. We wrote our 2024 outlook 3 months ago in October, and we had a 4 for 24 macro surprises. And very quickly, they were the first, lower inflation sooner than expected. That's clearly playing out both in the US and Europe. The second was growth and productivity. That's also playing out, right? Q4 productivity numbers were well and north of 3%. Surprise number 3 was the return to stability, which is where we think we are getting to now. And surprise number 4 was early cycle. And the early cycle evidence is really picking up, whether you want to look at the semi-cycle, home builders, new orders in the ISM breaking above 50 for the first time in 16 months, or even Asian exports. And you and I have talked about that in the past. South Korea exports in January up 18% year over year.
We're looking at a chart of the semiconductors right now. I pulled this from your report because I thought it was a good, simple visual to show why generally these stocks have been well received on earnings, despite a lot of them having trailing negatives in the semiconductor category. It looks like they're turning around.
Yeah, no, we're very bullish on semis. Semis are kind of like the new oil, right? And it's almost like going to a casino, right? If you're going to the casino, you got to have the chips. And it's the same thing. If you want to do anything in AI, if you want to participate in the AI revolution, you need chips. And NVIDIA to us is a classic example. It's the lead dog, it's the poster child for AI, and it's had a huge move. But what people aren't really focusing on, and what we think they should focus on, is the fact that earnings have grown so much that valuation has actually collapsed. And so NVIDIA, which has traded on average the last 5 years at a PE of 40 or above, is now trading at a PE of 25. And so you have your lead dog, your poster child, the cheapest it has been in 5 years. That to us is telling us we're early cycle. Then the semis have, we think, considerable room to run. And if you want to play, you got to have the chips.
I like that. It's pretty amazing, NVIDIA's valuation around earnings, but as you know, it's one of a kind. Even with years of efficiency and other big tech names, valuations have certainly risen, still below the COVID euphoria. But what kind of tolerance do we have for market-wide valuations, Jay, if the bottom for yields is in? Will there be some degree of tension outside of the absolute best names if rates are going back up from here?
Yeah, no, I mean, I want to say one thing before we get off
Sure.
the big Magnificent Seven, and that is to widen the lens again. Because if you go back and look over the 2 years, the last 2 years, from 2022 to 2024, 4 of the Magnificent Seven are up single digits. The S&P is up 7%. And so, again, if you just want to look the last 3 months, we've had a major move. Very rare move. The good news is it's typically coming at the beginning of expansions, not going into recession. And now if you think about where do we go from here, I think we're going to be earnings driven, right? Because valuation is not horrible, as we talked about with NVIDIA, but it's not cheap. The US market is not cheap. The rest of the world is very cheap. Cheap relative to their own history, very cheap relative to the U.S., and that's where we are turning our attention to the opportunities outside the U.S. In the U.S., it's very much an earnings-driven focus, and when we think about, we're looking at 3 main drivers. Rate cuts as opposed to rate hikes. We think we're early in a rate-cutting cycle. Global liquidity. People talk about the Fed, but let's remember the Bank of Japan and the PBOC in China are adding liquidity. And then you have earnings. And the consensus for 2024 and 2025 is for double-digit earnings growth in the S&P. And if we get that, then we're going to be fine over the course of the next year or 2.
I like the reminder that you guys are very bullish on the rest of the world too. As far as the rate cut component of the bull case, we heard some more language from Jerome Powell on 60 Minutes that seemed to echo last week. He's playing a little bit more hardball than he has in the past year on the March stuff. Does it matter to your thesis if we push March to May, or what if we even push it to June? What if we don't get that first cut till the summer? Does that matter on the margin what sectors, stocks, or styles you're in?
Yeah, no, I mean, perfect question. And you know, at TPW Advisory, we really believe in focusing forward, that the speed of change in today's day and age means you have to focus forward. And so we actually wrote a piece 3 weeks ago titled March or May, Who Cares? And our thesis is that it's much more important as to the why the Fed will cut rather than the when. And so the why is that if the Fed cuts because inflation has come down faster than expected, and therefore the real rate is overly restrictive, that historically is bullish for stocks. If the Fed is cutting because a recession is imminent, that's bearish for stocks. We're clearly in the former camp. We don't think it matters whether it's March, May, or June. We think the Fed is going to cut 3 times, maybe 4 at the most. And we don't care about it because we're not dependent on the Fed to protect us from recession. We're focused on growth. The economy is going to grow, we think, 2.5%. The consensus for GDP in the U.S. this year is 1.5%. People are still very behind the curve. The average S&P target for the end of the year is like 49.50. We've already passed it. So there's been a failure of imagination, and that's what we're trying to get to with our advice and with our clients, is focusing forward. The next couple of years is going to be better than expected, and therefore Wall Street needs to kind of recast itself towards a more positive outcome that's much less dependent on the Fed than it has been over the last year.
You got one last chart I want to bring up. We're out of time, but we built it. I want to make sure we show it because it's really good. It's the Bank of America Bond Volatility Index. And to your point, we're trying to break down through a very elevated range of bond volatility. So I guess put it in a chart. If this thing goes south the way we hope, then bonds are no longer a problem. If not, maybe we have a different conversation. But right now, markets have been working through it. Jay, thanks a lot for your time. Great stuff.
Always good to see you, Oliver. Be well.
Absolutely. Jay Pelosky, founder and global strategist at TPW Advisory. All right, a bullish tone to start the week, appropriate as we closed on the highs.